Thank you very much. Big thank you to our panelists. Don't forget, coming up, we have the Energy Tech Challengers Super Finals. We've got the top 7 pitches from the last day and a half, plus an extra Compute Challengers Super Finalist pitch. They'll be pitching again to become the Ultimate Energy Tech Challenger 2026 winner. Before that, we have a keynote on financing the climate capital stack. But now it's a pleasure to welcome to the stage for a panel discussion on early climate tech commercialization, structuring for scale and financeability, Rajan Shah, principal at Morgan Stanley 1GT, Jason Muehleck, head of ventures at Amrize, Daniel Stack, CEO of Electrified Thermal Solutions, Talia Rafaeli, partner at Kompas VC, and to moderate this panel, we have Daniel Goldman, co-founder and managing partner of Clean Energy Ventures. Give them a nice warm welcome to this stage. Thank you. Over to you. I can bring you some water.
Here, and nice to have a fantastic panel that hopefully will share some insights for all of you. Before we get started, I want to provide like a little bit of background on why I asked to bring this panel together at ETS. From Clean Energy Ventures standpoint, we've been working on structuring for scale, as we call it, for a little over a year. And the whole idea came about as we heard continuously about the problem with folk, the missing middle, and that there were really no solutions to this. And so we started looking at, well, we can talk about it all we want, but we need to find some solutions. So we started really doing some deep research, lots of interviews with folks in the industry, and ultimately that resulted in identifying some ways we could potentially address that problem. And what we tried to do is bring together key parts of the ecosystem, so commercial lenders and private credit, the insurance industry, which we feel can play a really important role, corporates, and then also catalytic capital, government funding, things like that, that also have interesting perspectives in this whole market. And our goal, our overriding North Star is how do we bring more debt capital markets into early commercialization? And we don't talk about folk because we think that's like a point in time, but early commercialization suggests that it's a continuum of scale up. You go from bench scale to pilot to demonstration to first commercial to second commercial. And that journey is challenging. Venture capital is a very important part of that journey, but we need other sources of capital, growth equity capital, but also we think the debt capital markets plays a really important role, and we'll come on to talk a little bit further about that. But that's how and then we held some convenings in New York Climate Week, at CERAWeek, and what we tried to do is bring our portfolio companies together with all of these groups to basically articulate what their challenge was, and then hear from insurance industry, private credit, what solutions might exist. How would they view the risk profile of those early startups? What risks would they take? What risks wouldn't they take? And I think what that led to was a number of solutions, including technology and performance insurance, but also things like construction debt funds, pooling of offtakes through like hyperscalers and others, and other mechanisms both at the project level and then at the portfolio level that might be able to address this challenge. And so the goal is ultimately, as I said, to bring the cost of capital down for scaling early commercialization as a means to be more competitive with incumbents in the market and also accelerate the scaling of new technologies, which I guess the word is that 30% of new technologies will be needed to address climate change. They haven't been developed yet. So if we don't scale up new technologies, we're not going to be able to meet climate change goals. And that was a big part of our drive to think about solutions. So without that further ado, let me dive into the questions. And I want to start with Rajan, who has deep private credit and debt capital markets experience. So we've discussed on a prior call project finance wrappers from 15 to 20 years ago that really unlocked capital in emerging markets. And It would be interesting to hear what specific wrappers, what kind of guarantees and structures that you think are most transferable to the climate tech ecosystem, and specifically early commercialization.
Yeah, absolutely. And maybe to preface the answer, I think it's important to frame that discussion as capital markets have managed to successfully finance high-risk projects across the world. At times where it was very difficult to price, for example, ISIS risk in 2015, and yet pipelines were built across northern Iraq out of Erbil. Now, the key sort of transferable lessons from that wave of financing start with the premise that we can do it. Sophisticated capital markets can provide, ways to finance that kind of risk profile and ways to price that risk. So the question really stems on what lessons can we draw from those financings. I think it starts with guarantees, whether that is in the so wrappers back in the day used to be on performance. It wasn't sort of looking to disintermediate or to reduce the complete failure risk. It was to reduce the underperformance risk. And so structuring guarantees and protections and warranties, both on the supply chain but also the performance of the assets, is a way to bring that risk premium down. I think secondly, on the construction side of things, milestone payments, we're all familiar with them. You do that when you're renovating your own home, for example. Those kinds of structured draws and structured repayment profiles, whether that be an interest-free window, whether that be a relaxation of covenants in the early periods of financing, those were lessons that we learned from the infrastructure financings of the 2010s in particular. And finally, I'd say loan performance guarantees and having that first loss capital meaningfully contribute to that loss given default calculation. And I think it all stems down to structuring, and with private credit in particular, and the way that project finance was done in the past, was a lot of this was bilateral. And so customized, tailored packages of covenants and terms are acceptable for the debt capital markets and should now be front and center of the minds of CEOs, founders, and VCs around the table.
Do you see the guarantees coming, mostly from the equity from the sponsors, or is it possible that guarantees could come from off-takers or other parties?
So yes is the short answer, and the long answer, which I'll spare the crowd, is it depends on who's providing those guarantees. So upstream or downstream, you can get guarantees from whether that's suppliers or whether it's corporate off-takers. Those are difficult to come by because there's a balance sheet question, and people upstream or downstream extending their balance sheets it's a risk question for them as well. However, there are insurance products and various other derivative products that can serve as the guarantees themselves as well. Right. So I'd say yes, this is the short answer.
Great. I want to turn to Talia. So you're an early stage VC. You invested at like TRL 5 or 6, hopefully going to 7 or 8. Typically partnering with corporates or off-takers. So I'm wondering, when you come into a deal and are thinking about its future, what contractual or sort of structuring elements are important to you and important for those corporate engagements, creditable, financeable? Do you look for your corporates to provide some sort of support as they're going forward as a partner in the capitalization of that company?
I mean, ideally, of course. I think every time we look at a deal, especially that is around TRL 5, TRL 6, we are looking to see kind of what is the ecosystem of players that are currently kind of at the table. So it could be anywhere from potential offtake agreements and commercial partners, all the way to suppliers that sometimes are also, part of the play. I think what's smart about early stage investing, especially when you're looking at companies that have these potential offtake agreements, is how you stack the commercial agreements, right? I think there's a strategy around that. The more bought in, right, the potential commercial partner is, especially at the early stage, the more you de-risk the deal, right, going forward. So it's either they come in as an equity play, right? They come in with some type of equity investments alongside you. So we have several situations right now where we have strategic partners that are investing together with us. That I think de-risks also, the financing going forward. And so I think there's also other ways to do this. Sometimes when you have offtake agreements that come together with, vendor financing, or when you see, essentially the partner is more bought in, that can look very differently. There's many options for that. So I would say that I think the role on the early side, when you're investing equity, is to really understand for the journey of the company, how can you de-risk the future financing? What is it going to take to bring in those debt facilities and really set up the company for success?
Great, that's super helpful. And just now to the other side of the equation, Jason. First of all, I would say that Amrize and the cement industry in general has been one of the most forward-thinking, leaning into the climate tech space. I mean, we see oil and gas players, see utilities playing, but just the level of commitment from the cement industry has been really strong, and Amrize and Holcim in particular. But I'm interested from your side and from the corporate side more generally, do you think about accepting like a higher level of risk in projects simply because it might have strategic value for your company? So and if so, so how do you decide when to anchor a really risky first project, with equity, with guarantees, versus saying, oh, let's just wait for the second project? We had a convening in Houston at CERA Week. Chevron sat there, and I'm not saying anything they haven't said publicly, we'll never do a first commercial project. So there are very different perspectives in the corporate environment. I'd love to hear how you guys think about it.
Yeah, I think everyone wants to be first to be second.
Yeah, exactly.
That's, I would say, that's general sentiment. So, I think, Rajan, you pointed it out as well, there's a balance sheet question of allocating capital. In the end, we're also allocating capital across, let's say, different opportunities that we have, and we have to be good stewards of that capital in that sense as well. Let's say, where we can create alignment is if it's very strategic to us and we see a large commercial opportunity in the future. If we can secure that commercial opportunity in the future by being early, by co-investing, for example, by securing commercial rights down the line to, let's say, be compensated for the risk that we take. It's also for us, it's a kind of a risk return question. And if you structure those engagements and those partnerships in the right ways, you can get to a position where the risk return balance is also in your favor, because you, for example, for something that, if it works, as to say, if first of a kind is successful, you've secured interesting commercial opportunities against your competition into the future, because let's say you were thereby, let's say, compensated for the risk that you took on early.
Yeah, that's great. So if you're on the other side of that equation, and again, like maybe you're asking not specifically for an exclusive, but some sort of first rights, how should financial investors perceive that? Obviously, it may accelerate the path to market, but it also could limit the market opportunity as well.
And it's exactly where you need to strike the balance, right? That's why sometimes it's good to be an equity investor early on, because you have competing interests. So you also want the company to do well, to say, due to your financial investment. The principle that we always, let's say, apply is it needs to be a win-win situation where there's enough of a commercial win for the company and also enough of a commercial win for us as a corporate partner. So it shouldn't be a question. You shouldn't have let's say, an issue going to your board and saying, hey, I'm going to take this deal because it's good enough for my first X units going with this company, because let's say it's attractive enough to say
puts
yes
you in business.
Deal. Exactly, just get good. Let's say have a good business. So that's the standard I think we apply. And then coming back to Rajan's question of very individualized deals, this is let's say deal by deal negotiation and how that looks like.
Yeah. Dan, I should mention, full disclosure, Dan Stack, Electrified Thermal is one of our portfolio companies, so really happy you'll be here. So maybe just briefly describe your technology, business model, near-term goals, and then maybe we can talk a little bit from a financing standpoint. What are the top technical and commercial risks you have that you're looking to mitigate and to be able to scale your technology?
Thanks, Dan. And yeah, over the last months, we've been engaged in these kinds of discussions, and in those rooms, there's been a lot of startups that have different flavors of what they need. So we've kind of seen different categories, but Electrified Thermal, we do industrial electrified heat to industry. And so what we are providing, depending on the business model that we're deploying with a given customer, the system is a box that goes on a site. Electricity comes in. We call it the Joule Hive Thermal Battery, and we heat it up with that electricity. And what comes out is hot gas, hot air that can run their furnaces or their boilers or their kilns. And so these systems, are about 5 megawatts apiece, and industry can need anywhere from a few megawatts to tens or even hundreds of megawatts. So when we talk about, the scaling that we are doing, you can have folks that only want a couple of units, but ultimately they usually need, a dozen units or more to really start to deeply electrify their processing. And that is, in contrast to groups that maybe need one massive plant to produce at scale some kind of, feedstock or material. We're really trying to scale up units on a few megawatts basis and then go to larger deployments. So one strategy, obviously, that's helpful is if you can do smaller projects first. Obviously, in total, the capital you need at that level is less. And you can kind of scaffold yourself from, and as an example, a cement plant. And in a past life, before Jason was at Amrize, he was at Holcim, and Holcim is one of our investors on the Maker Ventures side. So just as an example, we could do a few megawatts into a calciner that needs hundreds of megawatts, or call it 100 megawatts. So that's one luxury that we have that others who really their minimum project size is maybe a $50 million project, they have to contend with more, getting the capital markets comfortable for what otherwise is much more difficult to do with equity dollars. As far as the business models that we're deploying, there's kind of three flavors. One is direct equipment sale, which is nice early on if someone is willing to buy and take the risk on a first unit and own the asset. And actually, we've seen that the right partner is, because they may see process improvements with that system, and then they could try it once and roll it out to more and more sites. And so we've been contracting on that. We've built in language around, they understand it's the first time going in their, early commercialization journey, right? They see it's the first time it's going to be going into their line, doing that process, but they see the upside of what it can mean, and so they lean in and they accept, a certain uptime expectation in the first year, and then you ratchet it up over time. And so they've gotten comfortable. The other flavor is heat as a service, which you could do on balance sheet or off balance sheet, and we actually, for our first multi-unit project that we've been lining up in the north of France, we have a project finance partner who is getting comfortable coming in at that level already. And I think in that context, getting the right insurance around the project has been something we've been engaged with them on, where I think something like the tech performance insurance could help. But for us, some of these are maybe kind of obvious, where smaller capital projects help you get the momentum to ultimately deploy $50 to $100 million projects where we're doing hundreds of megawatts to sites.
And is that a redundancy factor? So, a calciner already has an existing supply of heat. You're adding on to that maybe at presumably at lower cost. But if you're, if one or two of your 20 or so, 12 units goes down, you have others to provide that heat, and they can also fall back on their existing. Does that redundancy help in kind of financeability?
That's right. And certainly, another luxury we have, or how we've structured our, offering, is that, an industrial won't adopt you if you go down and they're going to lose all productivity, right? So we're plugging in, in parallel to the fossil fuels that they have, or their traditional, business as usual. So if we go down, the worst case is they're back to where they were for a period of time, which is why they, these early partners are willing to stomach, the risk in some cases here. Another point, of course, is the more you get operating time and operating hours in general, folks get more comfortable for those larger projects. We have our 20 megawatt hour system running in Texas right now, and that's already at full scale. So they can come kick the tires on that and see the data from that to collectively get a picture that makes them comfortable moving forward.
That's great. Rajan, I want to turn back to you and talk a little bit about, from a Morgan Stanley 1 gigaton perspective, equity investors, but I think you have projects and you have debt financing around those projects. How do you see technology performance insurance as playing a role in that? Is that something that has entered into the equation, and do you see it as a valuable risk mitigant? And if so, if you can provide any examples, that would be great.
Yeah, well, I think conceptually, yes, TPI or sort of the insurance there is an example of the kind of wrappers we were talking about earlier. And essentially what that means for a provider of risk capital is that somebody is vouching for the tech working, whether that comes in the form of TPI or in the form of a corporate guarantee or someone upstream supporting the technology directly with cash outlays. The idea is the same. It's reducing the conceptual performance risk. TPI is important in many of these financing situations that we evaluate, and it's partly because most of the companies at this stage need both equity and they need a bit of project financing or debt financing. The reason they need the equity and the reason that the equity markets are deep enough to supply them with that initial capital is partly due to the value add that you get from having investors who are actively involved in your operations, but that is expensive money, as everyone here will know. And so TPI can help make the bankability of those early commercialization stories much more transparent. And the ways to do it really is to structure that TPI. It should be senior to any equity. The equity is the first loss. The TPI, should be supported by 10 to 20% thereabouts of first loss capital in the form of the equity. So again, the idea of having that hybrid approach and working across the cap table to provide these solutions is important. The second thing is tenor needs to be short enough to be meaningful. So that's 3 to 5 years, I think, is typical and what we would expect to see. Next, you'd want to see, various structural elements within the TPI. Metrics matter here. It's all about underperformance. And so gauging what underperformance actually means, using some of the KPIs, Dan, that you were outlining there. So whether that's uptime, availability, if it's yield or throughput, whatever the right metrics are, it has to be data-driven, and that will all affect the pricing ultimately as well. Yeah. So in short, yes, it's helpful. In our portfolio, we're seeing it more and more with extending the balance sheets of some of the manufacturing companies that we've invested in. But also, we've seen opportunities to expand more quickly than we were originally anticipating because you can fund a new plant build-out or a new sort of manufacturing facility using a form of equity plus TPI-backed debt.
Yeah.
And that's playing out in our portfolio today.
And do you see that coming in during construction, or is it typically like at mechanical completion or guaranteed performance of some sorts?
To date, for us, it's been post-construction. Mm-hmm. Conceptually, there's no reason why it can't be pre. Right. It's just a question then of risk transfer and pricing. But
and how deep do you think that market is?
It's deep enough to finance most of the early commercialization stories that we see. I don't know whether that percentage of that market is, but it is deep. I would say part of the role that we're trying to play is educating equity investors, either pre-existing investors or people that invest alongside us, that this form of financing exists. Mm-hmm. The depth of that market needs to be tested, but also obviously there is a competition at the moment to get access to those early commercialization stories in climate tech, and private credit, as we all know, is a deep enough market to support that.
Right. Great. Talia, I want to just come back to you. Like, you have investments in green steel or a lot of familiarity with green steel in similar cases. What non-dilutive or maybe quasi-debt structures might be available and sort of like accelerate scale up?
I mean, I think what we need to do kind of from the get-go is to ensure that any company, whether it's green steel, whether it's nuclear reactors, we need to think about how do we reduce technology risk, execution risk, operational risk, and bankability risk, right? And when we look at financial risk, to understand, A, is there going to be a commercial partner who can come on board and join the round, right? So it's on us to bring on, but that is dilutive capital, right? But then, we need to work with the companies to understand, okay, what are the available grants out there, right? You know, depending geographically where the company, you know, is operating, we need to understand, okay, how can we map out the different grants that are available? That is probably the earliest non-dilutive capital that you can potentially find, right? I think the next phase would be, okay, then what are we going to need in order to find, you know, mezzanine debt? Mezzanine debt is an important vehicle. Mezzanine debt can be supported by data, right? So you were mentioning kind of a lot of data collection. The earlier that we can collect data on performance, the more that we can set up the company for success with non-dilutive capital. And then I say it would be, how do you structure the company, right? Separating the IP from the assets, and then you would be able to kind of bring on much more, you know, project finance and more extensive debt vehicles. So it's really about understanding what the options are early on and being able to set up the company that way. So that, you know, we work by milestones, and each milestone will come together with, you know, a certain availability of non-dilutive capital.
Yeah, I mean, most debt structures are very asymmetric in terms of risk and return. I mean, you get interest on your loan, but you don't get any upside.
Yeah.
And is what you're sort of saying, like with mezz debt, maybe like more symmetry around potential more upside besides just interest for those mezz debt providers? Like, what are the examples of that? Like warrants in a developer, or some securing of a pipeline?
It can be a securitization. It can be warrants. I think there's a lot of options. Yeah, I think it's really about risk appetite, and it's so case dependent on the kinds of technologies. There's a lot of regulatory elements that come into play as well, geopolitical risk that we talk about. So it's really case, but those are good examples.
Yeah. Jason, just turning back to you, could you talk like a little more specifically about some of the corporate commitments that Amrize and Wholesome previously, when you were there, would make, like in terms of long-term offtakes? What do those look like? Would things like credit guarantees play into that mix? Supplier warranties, what other support mechanisms are there for helping the companies where you're already on the capitalization table and also want to play a role from an offtake perspective, especially where there might be symmetry between we're going to help the company and that's going to result in a better offtake?
Yeah. I think in our industry specifically, because most of the time there is still some market risk on new materials, offtake for the actual materials and let's say taking away market risk is something very important. So that's what we've seen just play out, let's say, as most attractive to either growth capital or then, let's say, debt providers in the ecosystem. Because if, for example, a new material doesn't fall under any standard, or let's say some of the adoption is still unclear, you need a certain signal to say, okay, aside from the technology risk and so on, who will buy this? What's the pricing? Are there enough volumes? And so on. This is where we've done, let's say, offtake commitments, backstopping essentially also up to larger amounts with our balance sheet to just signal to the market, yes, there's someone who will buy this, and this is the price that you can expect for that. So taking that risk off the table.
Yeah. How about on the operational and engineering side?
I mean, we have a unique approach where I think we deploy a lot of internal resources in the partnerships, where when we make an equity commitment or enter into a commercial partnership early on, there'll be 4 or 5 FTE on our end involved in that project from the engineering side. So, I mean, we've talked about this in other discussions, that companies early stage, they, for example, maybe lack the engineering expertise to evaluate early engineering studies. So there are a lot of things where there's expertise on the corporate side that needs to flow, let's say, to the companies for them to grow faster and say to execute better. And I think that's, let's say, for the corporates in the room, that's always a pointer. I think that is important to say. The engagement only starts when you make the investment. You have to be ready to make, let's say, further resource commitments for the cases to really be successful.
Right. Yeah, great. We have a little less than 5 minutes left, so I'm going to ask like kind of a surprise question, which is, if you look forward 10 years, you know, and we're talking about structuring for scale and early commercialization, what would you define as what would each of you define as success? What would success look like in 10 years if we develop mechanisms, we develop new approaches, and we get the market kind of leaning in. What would have happened?
Well, in my old world, structuring derivative contracts tied to commodities, success was ISDAs becoming widespread, templatizing those formats.
So we have a futures exchange that provides credit mechanisms for, for this kind of risk
I'm not pitching
profile.
sort of one of those
Love it.
fractional share purchasing platforms as a solution, but I think templatizing of these kinds of products would be an indication that the market is mature, accepts the risk, and knows how to price it in a standardized way. So success, in my view, would be the conventionality now, or how conventional project finance has become for infrastructure. It applies also to early commercialization risk.
Yeah.
And that we're not talking so much about commercialization risk as a category, and instead we're thinking, more forward-looking on, where can this go? So that for me is success. I don't think necessarily we're going to get there, but I think it's worth trying for.
Yeah, it's a great goal.
Yeah, I think I would have gone in a similar direction, kind of that there is a standard for these, let's say, financing structures that you can go out. The way a company can go out and raise venture capital today, you can go out and just raise, let's say, early commercialization financing. You know exactly what you need to provide, what you're looking for, let's say maybe even what pricing / interest rates you can accept and so on. From the corporate side, will also make it easier just to kind of map out a company's growth to then real commercialization to see where we can then really take benefits of the technology.
Yeah, great.
In 10 years, we won't need the early commercialization narrative for ourselves. We'll have been well past that, and we'll have fuel half-thermal batteries electrifying industry across multiple continents by that point. So,
and have gigatons of greenhouse gas emissions reduction.
Absolutely.
Yeah.
I'll go with a non-conventional route. So $41 billion has gone into financing climate in 2025, and the annual climate gap is 4.4 trillion. So that means 1% right now is being covered by existing capital on the early side. I would like to see that
gap
change
closed
dramatically. Absolutely, the gap needs to close.
Yeah.
And we need to find the vehicles to be able to do that at in a smart way.
Yeah. Probably many of us are familiar with the National Venture Capital Association term sheets and standard documentation. I'd like to see the same documentation for commercialization and addressing all those risks, and that would standardize, as you said, the process. We have like a minute and a half left here if there are any questions from the audience.
It's Thursday afternoon.
Well, if not, Rajan, maybe going to pick on you a little bit. Can you give us an example of something that 1 Gigaton has invested in, and just the example of how it went through its scale-up plans and secured debt financing?
Yeah, well, there's one that comes straight to mind. There's a company that was here last year called Instagrid, a Germany-based manufacturer of battery packs that are used on construction sites and increasingly in defense applications as well. The products themselves are essentially suitcase-sized, weigh about 20 kilograms, but can provide continuous peak power for about 4 hours of continuous use. So the point there is, this is a company that is a high-volume manufacturing company. And so the constraints to growth are manufacturing capacity and making sure that you have offtake contracts through distributors. Debt financing has been particularly helpful there because, as anyone here who operates or is invested in the manufacturing business knows, managing inventory and working capital is extremely important, and that is a second constraint to growth. And so by unlocking very favorable debt financing terms, both from local lending banks and also exploring the realms of possibility with venture debt providers, and negotiating those terms pretty hard to get them tailored to the risk profile of the company itself, we've managed to help the company unlock additional growth by reducing the balance sheet constraints to growth, but also making a platform or a standard or a template for market expansion, as and when the market recovers in particular geographies.
And is there warranty backstops as well provided with that?
This was conventional. There's nothing particularly fancy here. We're exploring a facility, it's confidential at the moment, for another company at the moment, which will include performance guarantees, which will include some form of warranties from both the upstream suppliers, but also for the downstream users as well.
Great. With that, Rajan, Jason, Dan, Talia, thanks so much for your insights. Really appreciate it, and great panel.
Thanks.
Thank you.